you think that the market has very much a sort of glass half full attitude towards what to expect in 2023, and you think some of the optimism is misplaced?
Yeah, look, I think there's as I call it, an impossible trifecta in markets, that I think that generally equity markets are rallying on the idea that there's going to be such a slowdown in inflation and the economy that the Fed will cut rates aggressively. Remember, if inflation just came down towards target, there'd be no reason for the Fed to cut rates. So this idea of the Fed cutting rates aggressively later on this year, not just pausing, not just not hiking as much as they promised, but actually cutting, is based on the idea that you're going to have a very sharp slowdown. So it's the yields are trading the idea that there's going to be a very sharp slowdown, and yet on the flip side, we've got this idea that equities are staying bid because, hey, we've got this immaculate disinflation, this Goldilocks scenario, and the economy won't slow too much to kind of weigh on stocks. I don't think that works, and I think that ultimately the outlet of pressure is more likely to be stocks. I think that if the Fed remains committed to fighting inflation, as I believe, and doesn't cut as quickly, then we will get a painful recession, and that will be very painful for stocks. It is certainly not priced in earnings nor in multiples. On the flip side, there is this idea that the economy stays very resilient. The consumer has been very strong, and that might continue to be the case. If that is the case, then the Fed won't be cutting rates. So it'll in fact be yields that'll go higher, and that might make it a tougher environment for stocks too. I'm not saying stocks do terribly in that scenario, but it just means it's not this wonderful, happy scenario we're trading at the moment.
Okay, I suppose does it depend then how wide you see that narrow landing strip as being, that Goldilocks scenario, that gap between these two extremes that you point out. If you see that middle ground as in any way visible, then maybe you have higher expectations for stocks this year, but you clearly don't.
I think that's like a reasonable scenario, so people talk about it, but I just don't think that people are really thinking about it. They've like not thought through the idea of like, okay, so why are the Fed going to be cutting rates aggressively? Unless you think CPI is way below target and disinflation. Let's imagine some very optimistic world where inflation numbers continue to come down rapidly. Remember, we're still seeing wage inflation that we're all very happy about, more than double target. Let's assume it starts coming down towards target. Let's assume inflation is on a wonderful 3% handle by the summer. It is still 50% above the Fed's target. So there'd be no reason for the Fed to cut unless there's a severe economic slowdown they're worried about, and they're worried about a real deflationary problem afterwards. So you're not going to get Fed cuts just on slower inflation. You're only going to get Fed cuts, aggressive Fed cuts, if they're worried about the economy.
And with that in mind, what's at stake when we wait for Jerome Powell to speak later? We've heard from Daly and Bostic and continue to tread that sort of hawkish line.
The general consensus for most economists out there is that Powell will avoid saying anything about rates markets in the US. He might push back on the idea of the loosening of financial conditions, so there's a slight risk of hawkishness there, and maybe if he doesn't deliver that, people will be very happy. I think, however, that more of the rhetoric, the aggressive hawkish rhetoric, is likely to come from the ECB over the next couple of weeks. They have made very clear they're going to look through the short-term numbers, and I think that's the message they're going to stick to in the weeks ahead.
Yeah, Christine Lagarde certainly starting the year with those kind of messages. Thanks to Mark for thoughts so far. Remember, you can get all the up-to-date analysis and insight into what's going on in markets. The Markets Live blog is available on the terminal. MLIV Go is the function to use.